Hi and welcome to Tradonomix Trading Academy. This is a foundation course to make you understand the basic concepts of technical trading. Let's begin with understanding what trading is. Trading is exchange of stocks, commodities, currency between a seller and a buyer. So typically you have a buyer and you have a seller looking for stocks for a particular price, and that matches, and then hence trading is created. Two types of transactions in trading. One is buying and other is selling. So we also call long and short. So during a buying transaction, what happens is you buy now and sell later, and the difference is your gains or your losses. Similarly, for a shorting of a trade, or rather selling of a stock, it is selling now and buying later, and hence you calculate the gains or the losses. To do trading, one should possess different types of accounts, since these days everything is online. So for a trader or for trading, you need a savings account where you have your funds parked in. You have a trading account where the transaction of the or the monetary transactions for that particular trading transaction happens in a trading account. And you have a demat account, which is primarily an account meant to hold the stocks or transfer the stocks. So what typically happens when you buy a stock? When you buy a stock, your savings account gets debited for that particular amount of the number of stocks what you buy. The amount moves through a trading account, and then your stocks what you purchased, or the stocks what you purchased in an electronic form, is credited into your demat account. The vice versa happens when you sell the stock. Let's see it in numbers. When you buy 10 shares of Infosys at say 3,000 rupees, your trading account gets debited for 30,000 rupees. Your demat account gets credited for 10 shares of Infosys. So you have 30,000 withdrawn from your savings or your trading account, and 10 shares of Infosys shares credited into your demat account. Likewise, when you sell it, say you sold it for 3,500 for 6 months later, and you have your demat account debited for those 10 shares of Infosys, and your trading account gets credited with the value of 35,000. You would have other costs attached to it, which is your transaction fee based on your broker or your trading company whom you're dealing with. So there are two types of traders, or rather we say methods of trading. One is a fundamental trader and the other is a technical trader. So who's a fundamental trader? A trader who works around understanding the health of a company, be it a financial health or be it a organizational health, by understanding the goal of the company, its achievement of the management, the growth aspects it's moving into, the kind of turnover it has created and it will create in future. So understanding a lot more details about this, and hence trading those stocks, are called fundamental traders. And a technical trader would go with understanding the price movements against the volume movements, typically in a graphical representation. So technical traders, although they do go by the news, but they rely on technical representation of these price and volume movements through various charts. hence the importance of charts for a technical trader. So charts are primarily a graphical representation of the data of price. There are three types of charts. One, we would call it as a bar chart, where bars represent the movement of price as shown in this picture. You have the line chart. The price movements are denoted with lines. And you have the most commonly used by technical traders, the candlestick chart, where candles are representing the price movements in this particular chart. Let's understand the formation of candle, or rather how do you read a candle. The candle, like a typical candle, has a body and it has wick. Here we have two types of wicks. One is the upper shadow and the other is the lower shadow. So this candle which is displayed in my screen is a green candle, which we call it as a bullish candle, primarily because the price has started low and moved to a higher price, and hence it's moved upwards. So this candle is called a bullish candle, and you can see that it has a lower shadow and it has an upper shadow. Primarily, the price starts, or rather opens at this level, and it travels from the lowest position to the highest position, but finally close at this position. So the lowest position of the body of the candle is the open, and the highest position of the body of the candle is the close price of this particular stock at the time frame. And so you can see that the price moves from a very low position to a high position, but it has an open and a close in the body of the candle. So you have a similar candle but in red, and that's called the bearish candle. It has again an upper shadow and a lower shadow, but the difference between the bullish and the bearish candle is, in the bearish candle, the price starts at a higher, the candle starts at a higher price and it moves down to a lowest price, and hence it's called a bearish candle. So here you have a clear differentiation between a bullish candle and bearish candle. In certain charts, it is differentiated as a hollow candle, and the other candle would be one which is marked. Now that you know a candle, let's understand how to read a candlestick chart. The most important thing to understand in a chart is what is the movements. So it's a rally movement or a decline movement. So let's understand rally. Rally constitutes a series of price candles which are making higher highs and higher lows than its previous candle. Okay, so any time frame, say each candle, say for example, it's a daily chart. If it's a daily chart, each candle will be a day. So you have higher highs and higher lows, which means every day it's making higher price, and hence this is called a rally. An example of rally, you have a series of bullish candles making higher highs and higher lows, and hence it's a rally. Now for decline, the reverse order, where you have series of lower high candles and lower low candles and forming a decline. A quick example of decline, you have these bearish candles creating lower lows and lower highs, and hence this area or this movement is called decline. Why do you need to know a decline and a rally and candles and pivots. The only or the main use of this is to understand or determine the trend of the stock. Trend is a friend until it breaks. So it is so important for technical traders to understand the trend which the trade is in or the stock is in before they use any concepts or methods. So the basic foundation is to understand the trend and then use your concepts in the direction of the trend. You cannot change the direction of the wind, but you can change the direction of a sail to go with the flow of the wind. Similarly, you can't change the direction of the trend, but you can use concepts, strong methods, and the knowledge to flow with the trend and make your successful trades. You have a series of bullish candles and you have a series of bearish candles. So these bullish candles creating higher highs and higher lows are rally, and you have a series of bearish candles creating lower lows and lower highs creating a decline. So the meeting point of a rally and a decline is called pivot. You have a pivot high and a pivot low. So rally meeting the decline is pivot high, while decline meeting the rally is called a pivot low. Quick example, pivot low, that is a decline meeting a rally and it's a pivot low. So again you have a rally meeting a decline, it's a pivot high. Decline meeting a rally, it's pivot low, and so on. By now you would understand why we are teaching you, or rather making strong understanding of candlestick formation of rally, formation of decline, understanding pivot highs, pivot lows, because these constitute a trend. There are three types of trend. One is an uptrend, the other downtrend, and you have something called sideways. Quickly have a look on this chart where you have a downtrend, you have an uptrend, and you have a sideways also. Fantastic. So you can see that a series of pivot highs and pivot lows have constituted a downward movement and hence a downtrend. A series of pivot highs and pivot lows have created uptrend, and a series of pivot highs and pivot lows, but they have neither an up nor a downtrend and hence determined as a sideways. Let's quickly understand this. So a series of higher pivot highs and higher pivot lows constitute an uptrend. Here it goes. An example. You have an uptrend with a series of pivot highs and pivot lows which are higher than the previous pivot high and pivot low, and clearly denotes an uptrend. So this is clearly a graphical representation of what a trend is. Now for downtrend, the similar action but in the reverse direction, which is series of lower pivot highs and pivot lows moving in the downward trend. Quick example, you have a pivot high, pivot low, pivot high, pivot low, and all these are in the lower pivot highs and lower pivot lows of the earlier pivot highs and lows, and hence it creates a downtrend. What is a sideways? When the price makes, higher pivot high but a lower pivot low. Let's understand that. Here up till this position, it has higher pivot highs and higher pivot lows, and hence this area is an uptrend. But what has happened here? At this position, it has created a lower pivot high but a higher pivot low, and hence we are not clear that it's moving into a downtrend. So we can't determine it as a downtrend. Why? Because a downtrend, you need a lower pivot low as well. This range is determined, or rather called as sideways. You have an example. So here you have higher pivot highs, and you have this pivot high formed as a lower pivot high, and you have a pivot low which is higher than pivot high low which is created, which is higher than the earlier pivot low. So this range is called the sideways. So it can continue as an uptrend, it can move as a downtrend, we don't know. So we are standing at this situation, and hence we determine this range as a sideways. What does Tradonomix do in our intermediate course? A quick glance of it. You know what a pivot high is, you know what a pivot low is, you know what a candle is by now. So you can determine what downtrend and uptrend is. But let's go a little more in detail in the intermediate level. We teach you what is an intermediate pivot high and what is a minor pivot high, and that makes a lot of difference in trading. You have a different method of trading in minor trend trading, and you have a different method of trading in intermediate trend trading. But for all these, your foundation to understand trend is of utmost importance. Tradonomix technical trading course, the intermediate level on price action trading, explores and makes you understand trading the minor trends, trading every pivots possible, and hence consistent trading achieved. We also in detail teach chart pattern trading. Chart patterns are truly signals for traders to make a quick decision on entry as well as exit. So here you can see this is a flag pattern in the chart, which quickly helps the traders to understand that this is a buy situation for me. Likewise, there are umpteen number of patterns, and Tradonomix would teach you to trade not only the expected moves but the failure moves, failure to expected, expected to failure. So multiple scenarios. What do you need to do on these scenarios? How to trade them? What would I do if these kind of situations fail? All these things are covered in our intermediate level. Let's get back to our foundation concepts of technical trading. The next concept which we would like to touch upon is gaps. Gap is the difference between price difference between the close of the previous bar and the open of the next bar primarily the candle. So no trading happens in this area, and you can clearly see this gap in a chart in any time frame. So let's take this example. You can see over here there's a bearish candle, there's a red candle followed by a green bullish candle, and that clearly has a gap in between them. So there was no trading for probably a couple of seconds. If this is an hourly chart, then an hour or some time frame, and it has gapped up. So primarily this is called a gap up. You can see similar thing happening here, where it's a downtrend, you have a gap down happening. Let's understand what the next concept is, support and resistance, which is of utmost importance to traders. Support is a place where one can expect a lot of buying, and resistance is a place where one can expect a lot of selling. So support is the demand area and resistance is the supply area. You can see this major support where a price of say 91 for this stock, which is Allahabad Bank, it's an hourly chart. 91 is the price where you can see repeatedly the price hitting 91 and moving up. So you have a support at this price called 91. You can also see sideways. Now that you know what a sideways is, it's neither uptrend or downtrend, or neither moving up or down. So this situation can also act as a sideways, can also act as a support. So here you can see in July the sideways has acted as a support in October 2014. The other support where gap acts as a support, you can see that there is a gap up, and that position or the gap has behaved as a support in the future years or future time frame. Round numbers also behave as support. So here you have a round number of 900 behaving as a support and not letting the prices move further down. It is stopping at 900 and pushing the prices back up. Resistance, again, we have all these situations for resistance where you can see in this chart at say around 6,400, there's a huge resistance happening at different intervals, and the prices are not moving above this level. So the huge resistance there, not letting the prices go upwards. Sideways again behaving as a resistance, and you have gaps again behaving as resistance. So you can find sideways, gaps, and round numbers behaving as support as well as resistance. What is role reversal? When the support starts behaving as a resistance, that's when the role reversal happens. Now here quickly to understand that, in position 1 and 2, you can see there's a huge resistance. The price is not moving upwards at all. But when in this situation, after point number 2, the price has gone ahead and it has broken this resistance and moved upwards, and then from then the resistance has started behaving as a support. So here's a quick example where you can see that there's been a good resistance over here at say 230 levels, but once the price has cracked up and it has broken the resistance and moved up, it has now this resistance of 230, around 230 has become a support area. The support becoming a resistance. Similarly, when there's a strong support and the price breaks the support and falls below the support, this support levels start behaving as resistance in future. Quick example, at say around 280 levels, you can see that there has been a good support, and this support, the price has broken 280 levels and fallen below it, and then from then onwards this support area becomes a resistance area. Please understand that support and resistance is of utmost importance for a trader. It helps the trader in taking the right entries, making partial profit bookings, and even full exits, or rather getting out of the trades with full profits. So support and resistance and understanding the levels of support and resistance is of great importance for traders for their successful trades. This has brought us to the end of the foundation course. Tradonomix welcomes you to join our journey in learning and transforming to a technical trader with our exciting courses on intermediate and professional courses on advanced levels. Intermediate level will help you to understand and also do your first level trading as a technical trader. you will learn in detail about trend, understanding trends, getting the trend to your side, and making the right entries and exits or small minor trend trading in intermediate level. We also will give detailed explanation and exposure in chart patterns and trading the chart patterns, along with trade management. Trade management is one of the most important aspects in trading, and this will be covered in detail in the intermediate level. From then, your journey starts as a technical trader. Advance yourself to our next level, Tradonomix Advanced Level course, where we would teach you our unique methodology of ERL, VRL, which is our line concepts. We also would give you the right method to become a successful trader, ITF method. Join our journey, visit our website, and come become a trader. Thank you.